Well, I don't know if the question goes to me. I have to state that very clearly. This is no bailout. This is a commercial solution because we have a takeover of UBS. UBS is taking over Credit Suisse. So this is a commercial solution and not a bailout. We really wanted to avoid a bailout for different reasons. But I just maybe come back to the question of the too big to fail framework. The too big to fail framework couldn't have been applied here really because usually, this is applied to a bank that cannot meet its liabilities anymore. And here we had a problem of liquidity. So it is not typical at all, And as I stated in my introduction also, the bankruptcy of Credit Suisse would have had a collateral damage, a huge collateral damage on the Swiss financial market, also risk of contagion for UBS and other banks, and also internationally. So I was in contact with my colleagues from UK and USA. They are very grateful for this solution because they really feared that there could be a bankruptcy of Credit Suisse with all the losses. And, the taxpayer in this scenario has less risk. The bankruptcy would have been the highest risk because the cost of the economy would have been huge, the Swiss economy. Then I would say that any other scenario that could have been imagined in the too big to fail scenario would also have had more costs than if you have a private partner, a bank, a solid bank that says we take over Credit Suisse. What we do is something that is, the governor of the central bank pointed it out, is a instrument that is well known in other jurisdictions like the UK or the US, which is the PLB, which is a guarantee to the central bank. It's not money we give to Credit Suisse or UBS. So we find that this solution is the best solution, and I hope it will also be welcomed by other jurisdictions.